All right, all right. Let's just go ahead and have a little chit chat before 2:30. That way I know that the audio is working and the picture can be seen and everything is doing what it's supposed to do. Y'all can hear me, huh? Órale, güey. Thank you, sir. Appreciate that. You should be able to see the picture on the screen too. Class number 2, Introduction to Options. All right. So as we talked about last week, this is an introductory course. There's nothing advanced level about it, but of course the floor is open to questions along the way. Questions, it doesn't really matter how complex they are, just that this class is focused on the introduction material. You may have heard a lot of this stuff along the way, but these videos are being recorded and they're going to be on the bullish bears, mainly as a starting place for new traders who are perhaps thinking about getting into options. So a lot of it might seem very basic, but that's the idea behind it. So in the last class, real quick, we just kind of did a review of where options started back in the 70s, a little bit about why the pricing models work the way that they do. And now from there, we just want to start actually getting into these contracts. And I guess we all kind of approach that name differently. But when I hear contracts, when I was new, it really kind of freaked me out. Like, wait a minute, I don't want to sign a contract. I don't want to sign anything. Like some old Rumpelstiltskin, somebody's going to hold me accountable later on for something. I didn't want to get into that complex kind of stuff. And of course, there's a lot of horror stories out there about people who traded options incorrectly, and that they ended up losing a home or putting up thousands of dollars of risk, or ended up with a oil tanker sitting out front of their house. They goodness knows what you can get yourself caught up into when you don't understand what you're trading. But these contracts, really, they're more of a name than anything else, and the brokers have really automated the process where most of them nowadays will actually kill your trade before assignment. They won't let you get assigned. They will kill your trade. Robinhood is famous for this. At least they were. I don't trade much there now, but they would kill your trade if it triggered risk assessment measures on the day of expiration. So like around noon, you would just find that you're no longer in a trade. They would close it down, and they didn't care if it was profitable or not. They didn't care what your strategy was. It was just, well, today's expiration day and it's moved X amount of distance, and so poof, there goes your trade. Some brokers will warn you constantly that, hey, you've got this option and it's going to expire in 5 days. It's going to expire in 4 days, 3 days. Hey, this thing is still expiring this week. So, and of course, if we get bombed with too many emails, we eventually just start to tune them out. We don't even read them anymore. We just throw them in the trash like, yeah, whatever. Keep in mind that it is a contract. So what happens when we go and trade in these options is that we are agreeing to something, and there's typically a market maker on the other side. So when we say that we sold to somebody, I mean, in your mind, you might imagine that you're actually selling it to another person, but more often than not, it's just some market maker on the other end, and they don't have a directional bias. They don't care if the market's going to go up or down. They don't care if your trade is a winner or not, or if theirs is a winner or not. They just care about making the money differential between the spread, the bid and the ask. And they're going to hedge the trade with stock anyways, so it won't matter to them which direction it goes. Although it is easier in our own mind if we imagine that we are trading against somebody else, right? That way, when we do think of buying and selling something, there actually is someone on the other end that we're haggling with. So just like most contracts, you can get out of them if you go through enough work. So with these, as long as the trade is still open, that the expiration date has not come through, you can always buy back whatever you sold, or you can always sell whatever you opened. It might cost you a fortune, just like getting out of timeshares might cost you a fortune, but if you really want out of it, you can get out of it. There may be a price that you are unwilling to pay, but it was there. You could get out. So keep that in mind too. When we talk about the trades, and this is one that I see all the time, and I know I get to be the jerk that reminds people that they didn't buy a credit spread, they sold a credit spread, and they need to buy it back to close. And I always feel like a jerk when I remind somebody of that, especially when it's a new trader. But we have to speak clearly about the trades that we're in, especially when we're trying to talk to somebody else about that trade. So make it a habit when you're thinking about your own trade that you didn't buy a credit spread. You sold a credit spread. You sold it to open, you'll buy it to close. And by keeping that in your mind, you will keep track of what you need the trade to do to be profitable when you exit. Make it a habit to think about it that way and to talk to other people about it that way. Most trades out there have their norm, like a butterfly. We almost always buy a butterfly to open a trade. It's rare to sell one, and I'm sure that there's some strange strategy out there somewhere where somebody is selling to open a butterfly, but more often than not, a butterfly is bought to open. Iron condors, on the other hand, are completely the opposite. More often than not, they are sold to open. However, it's not uncommon to see a butterfly or an iron condor that is bought to open. It's getting a lot more common because of these gamma squeezes that are coming around. But having said that, if you keep track in your mind of what it is that you're doing, did I buy this to open it? Then I bought the trade. Did I sell it to open? Then I sold the trade. That way the people that you talk to understand your trade also. Any questions on that before we go on to the next one? Now, I shared this document a little early. I had meant to actually share it last week, and for some reason, it didn't get shared. I didn't get it done. This is where things start to get a little fun, and we get into a little bit of the math. But don't let that freak you out. This is very simple math. It's very easy. We're just adding and subtracting. We're not going to get into anything like square root and standard deviations. But if you know how to do that stuff, it will help, especially standard deviation. The marketplace overall, whether you never trade an option or not, is completely and totally attached to a standard deviation. And the sooner that you recognize that fact as a trader, the better off all of your trading will be. That the entirety of the marketplace is connected to a standard deviation, very much like a yo-yo. You flip that thing out there, it can only go so far. If you do want a trade to be assigned, you have to reach out to broker and let them know. Because default position, most of them are going to kill it for you. They're going to say, you know, oh, this person's in danger and they're not paying attention, so I better go ahead and close this trade for them. So if you do want it, if you do want to be assigned, you just reach out to them. On Thinkorswim, that's really actually pretty easy because it's got the support feature in the upper corner of the screen. So you just hit support and let them know. You could call the trade desk. And like we talked about in the first class, you definitely want a number that you have at hand all the time. And preferably you call it early. You get a guy, you get a lady, you make that your person so that when you need to make that call, you call Beth or whoever, right? And the person knows you, you know that you can get a hold of them. They'll take care of things for you. I always like having a person, whether it's my brake guy or the car guy or the the person who cuts my hair. Every place I go, I got a guy, I got a gal, I got a lady that takes care of that. Same thing in the market. You don't want to have to fumble around going into expiration trying to figure out, like, well, who do I need to call to get these shares? It's also a great tip for working on credit or anything else. Get to know a banker so that when you need a loan for a car, it's not just some Joe Schmo. You call up Beth and, hey, I need a loan for this car. Yeah, no problem, because it's your banker. It's the people that you deal with all the time. Personalize everything, and then it just becomes normal. All right. So what happens when we buy a call? What's really going on there? When we buy a call, we're entering into a contract. We're making a decision about where we think the market will be in the future, and we are working with somebody else, making a little bit of a bet, and we're agreeing to a transaction at expiration, even though we can kill the trade at any time. Maybe we would just want to buy a call, see it move 20 cents and sell it. That's fine. That's trading like a widget, and there's nothing wrong with trading that way. But when we enter into a contract and we buy a call, we're actually agreeing to do something. So there's intrinsic value and there is extrinsic value. If I trade a call option at the 100 strike and price is at $105, then I've got intrinsic value of $5, because that option is giving me the right to 100 shares of stock. I can make somebody give me their stock at $100 a share, even though the current price is 105. I'm in the money. So I could, quote, call away somebody's stock at $100 a share. That's what the contract gives me the right to do. I can exercise that right, and I can call their stock away from them at $100 a share. Yeah, I absolutely can do that again. It's in the room where the other one was, but even though this says part one, it'll always say part one. It actually is part two, and it's just a continuation from the first one. So it says one because that's just the name of the document. No worries. I didn't want to keep renaming it, although I guess it would probably help if I did. You'll know that you're in the new document because this one actually has 11 pages and the other one only had like 7 pages. So when we buy a call, we're buying the right to take stock from somebody. That's what we're buying when we buy that call. Now, like I said, most new traders, they approach options from this idea that, well, I just want to buy it for 85 cents and sell it for $1, and yay, I made money. It doesn't have to be that way, and there's nothing wrong with doing that, but you are entering into a contract, and you're the one in control. It's your contract because you initiated the trade. So if you buy a call, you're in full control on whether or not you call away somebody's stock. If the stock is sitting at $94, you definitely would not want to buy somebody's stock at $100. You could just buy it from the market, at fair price. So your call would be worthless. You wouldn't want to exercise that right. But if you bought the 100 call and price ran up to $200, you would absolutely be in the money, because you could still force someone to give you those shares at $100 a piece, even though the stock had ran all the way to $200. So buying a call gives you the right to take stock from somebody at that strike price. And there's a lot of ways that we can trade that, but that's really what you're getting into. And the intrinsic value of those options are how far past the strike price has gone. So for an example, we'll just use SPY. SPY is at 413.60. So if I was to go in here and try to buy this call, the intrinsic value would be 60 cents because I'm in the money 60 cents. And if SPY continues to move up, however much farther past 413 it goes, every penny is more intrinsic value because I'm in the money. It has internal worth or internal value. It can get really hard to calculate extrinsic value because extrinsic value comes from multiple sources. But when it comes to intrinsic value, it's very simple, very basic math from the idea that we know what the stock price is and we know what the strike is. And all we ever have to do is subtract those two. In fact, at any time when you're trying to trade, if you're looking to buy a call at the 412 and you're asking yourself, like, I wonder what the actual price of the stock is right this moment, you can look at the intrinsic value. We're at 413.58, 56, 59, 57, just like that. You can see where the stock price is because you can just add that extrinsic value to the strike price. Now, I've had people tell me math is stupid and that they don't want to have to learn math to trade. And unfortunately, that's the name of the game. You know, that's like saying that that you're really worried about greenhouse gases and that you never want to run your air conditioner. I mean, I get it. You could ride a bike to work or get a dog, or, you know, ride a horse or walk, or you could use gas. So, you know, we might not like these things, but we still got to use them. Math is the name of the game. If you can do math better than somebody else, then you have an edge. Typically, though, we're just trading against market makers. So when we're trying to price a trade, if we're trying to figure out, like, am I buying this call for a fair price? Because I don't want to get robbed. I don't want to be that sucker going in there and buying something for $1 when it's really only worth 35 cents. To try to see if we're getting a fair price, some of the things that we can do is look up and down the options chain. Now, in something like SPY, this isn't really much of a question because it's very, very liquid. But there's a lot of stuff out there. So imagine if we was to go out to Google, probably isn't a good choice. Let's go to X Steel. If we go and look at something like X Steel, you'll start to get this out of the money bag holders where people are just kind of holding on to junk and they're hoping eventually to get saved. And you'll start to see some odd prices way out of the money. And you got to start to kind of ask yourself, is that a fair value? Even X Steel isn't showing something really nasty, but if you find a product that has made big moves in a day, you'll often find a lot of these bag holder positions way out of the money. And the numbers will often be as high as what you find near the money. Like somebody's just putting a price on it and praying that it gets filled by somebody. So you got to kind of ask that question, is this a fair price? Maybe look up and down the chain, look into different expirations, try to look around and see if the price that you're looking at matches what you're seeing farther away. If it's way out of the money and they're wanting more money for it than what's at the money, that's not a fair price. Something's wrong. It could just be bag holders. It could be just a lack of liquidity. There's a really good volume in here right now. So that's not much of an issue that close to expiration, but maybe 24 days out, yeah, a lot less volume. These pricing models can get really screwed up. And it can get tricky to try to figure out where that fair value is. There's some of those numbers that I was just talking about. Notice the 16 strike. We've got 75 cents here. So if we were trying to split the bid between 2 pennies and 75 pennies, what are we looking at? I don't know, 38 cents. Well, we could trade cheaper than 38 cents at the 17 strike, right? So these numbers just don't make any sense. These are not fair and accurate prices. So when we can understand the bid-ask spread, when we understand what the intrinsic and extrinsic values are, then we can start to understand if we're getting into a trade that might not be fair. Questions on that intrinsic and extrinsic value? One of the ways that we can use the bid-ask spread is to try to find that mid price or the mark. And when you add the intrinsic and the extrinsic value together, it should equal mark. Well, if you're out of the money, it should just be the extrinsic value, because there is no intrinsic value out of the money. So you should be able to see that the extrinsic and the mark are the same price if you are out of the money. And if they're not, then right off the bat, there's something wrong with this pricing model. So this is a really great example on X steel. I turned on the extrinsic value, and we can see how the options pricing is going from $1.93. It drops down to $1, down to 51 cents, all the way down to 20 cents. Then things start to turn around, start getting back up into the 28s, the 20, 27, 25s, 35s. Those are not fair and accurate values, and you can see, because we should decrease in value the farther out we go, right? Our chances of making any money are decreasing the farther out we go. So that's just a really simple ballpark way of looking at, quote, fair value. Now, I wrote this after having this discussion last week. I tend to stay a week ahead, like I'm already writing this week's, even though we won't use it until next week. So, we did kind of go over a little bit of this stuff last week, just in chat, not necessarily as a part of any class, but we had already talked about these things. It still makes things a little easier to understand when we go back and review them, look at them again, talk them over. And it connects a little bit today into the unusual options activity that we had talked about earlier, trying to figure out the intentions of the flow that we would see in an option, especially like black box stocks or cheddar flow. When we see these large trades coming through, we need to look at all of the information, including, did they hit the ask? Did they reach beyond the ask? Did they pay more? And if you look at this picture, when price was at 50.78, this trade with the 50.5 strike had an intrinsic value of 28 cents. combined, yeah, we could roll it all together and try to figure out where the mid was. We can look at the mark. Either one of those would be fine. But when we're trying to price this out, if the middle of the trade matches exactly where price is, who would be willing to pay more than that? Who would be willing to pay $52 when price is at $50.78? Only somebody who really wanted the trade, right? Well, we can see the bid ask, and I believe this picture was taken after the market had closed. So none, all these values get a little wonky, but the bid is at 50.50. The ask is at 51.28. That's 75 cents difference in there. So that, things can slip quite a bit. If we see a bunch of flow coming in greater than what is equal to the current value of price, you got to think, man, they really wanted that trade, right? Because why would somebody spend $2.4 million to buy XLE at $51 when they could have bought it at $50.78? Maybe they just really wanted in the trade. When it does come to extrinsic values, though, things get a little more complicated. Extrinsic value is based on interest rates, which we hardly ever calculate, think about, talk about, look at. They're just priced in. We don't even concern ourselves with it. But we have to say it. It's there. It exists. They do impact trading in the options market. But for us retailers, it's not something that we would ever really talk about, think about. I just put it in there because technically it exists. We should recognize that it's there. But implied volatility and time are the other two components that change the value of that option. So price does not have to move at all for your option to gain value or lose value. Remember that the intrinsic value is how far in the money we are. So if price doesn't move and the option suddenly gains in value by 50 cents, we know that two things had to change: time value or volatility value. During the day, theta does go up, but more often than not, that's not what's changing the value of your option. If the stock didn't move, then your option didn't gain theta value. It had to come from volatility. And when volatility changes even a fraction of a percent, the value of your options can go up and down. It's understanding those values is how you will understand what is impacting the options trade that you're in. A lot of newer traders who begin trading spreads often freak out when price makes drastic moves and they don't see any profit in their trade. Like, what happened? Did I build this thing the wrong way? Is it is it broken? What's the matter? Price moved $10 and my trade didn't even gain 10 cents. What happened? Well, when price makes drastic moves, it typically changes volatility. And if you sold to open and the trade lost value like it was supposed to because price went in the right direction, and then it gained value from a swelling up of implied volatility, it actually gained more value from the volatility change than it lost in the price move. And then your spread doesn't show you that you made money. The rate of change comes from delta and we'll start getting into those Greeks later on. The main thing is to understand where intrinsic value comes from, not from trying to calculate it on our own. And I see that one a lot, that people will sit there and try to determine, okay, I'm going to hold it for 4 days. It's got this much theta. And if we move 2 points, it's going to change by this. You can do that, but it's just going to hurt your head. And then the market's going to move 50 cents and all your calculations are going to be thrown out the window and you would have to start all over again anyways. You might as well just let the broker do that work for you. That way you're not constantly trying to struggle and figure out what that value is. Let the broker determine the value of the trade, and you keep in mind where it's supposed to be going, right? Like theta, depending on if you're on the winning side of a vertical or the losing side of a vertical, theta will either pay you money or take money away from you. That trend is already established. We already know it's going to go one direction or another. So you don't have to calculate necessarily how much theta you'll get on a day-to-day basis or per dollar move. You could instead just define the concept that this trade will pay me theta or this trade will be costing me theta. Quick side note on theta, they do not tell you when that theta will be applied for a reason. They don't want anybody to game the system. So it's a random calculated thing, constantly changing on a day-to-day basis, and you will never be able to pinpoint when the theta value will be applied. It could be 1 o'clock in the afternoon, it could be 10 in the morning. You'll never know. They don't want you to know. And they made it as complicated as they could so that you could never game the system, because there are some very smart people out there, and the trading firms will find any edge that they can find. And you know that they would be able to exploit it way better than we could. So that covers the intrinsic and extrinsic values. It covers the pricing of the option, getting a fair value, which is really what I wanted to target today in this. And I didn't want to make it too long. I didn't want these sessions to, be a marathon that somebody has to sit for hours and work through. Now I can kill the recording and we can, talk about whatever. If you have questions on what we've covered today, I'll leave the recording on, I'll answer those, and then kill the recording. We can go from there. So if you guys got any questions on what we covered, this would be a time to do it. Yeah, absolutely. Now, next week I will have, I'm going to be gone because I'm going to be having a personal day on Tuesday, but I'll be back the next following Thursday, so there won't be any problem there. Well, let's see if we can kind of figure that out. So you're saying that Suppose you buy a call and you pay $1 for it. And then you sell it for, we got to have a price on the sale. So say you sell it for $1.05. You made $5. You recouped the 100 that you paid to begin with, and then you ended the trade $5 ahead of the game. So the word premium seems to be what's throwing you off. If you instead just look at the value of the trade, and it would help if we have something to look at. So I'll just bring up X steel here, knock this down to some smaller numbers. So here's X steel at the money, and they're wanting somewhere around $1.08, $1.07. So that's what it would cost me to get into this trade, $1.07 at the mid price. If I sell this for $1.57, I recouped my 107, and then I made $50 profit. I didn't make $157. But if I add the word premium in there, premium can really throw people off, just like the word margin. Margin means so many different things. It can mean that I'm borrowing money. It could mean buying power. It could mean borrowing power. So margin can be real confusing, and so can the word premium. If the premium in this trade is 106, then you recouped that, and then you made profit. If we sell it at 156, then you made a profit of $50. The same thing the other way around, though. And that's why just the wording can be a little off. If I sell to open this trade at $98 and then I buy it back at $48, then I made $50 profit. But if it starts to go against me and I have to buy it back at $1.98, then I lost $100, right? I had to give them back, quote, the premium, and then I had to fork out an extra $100 to close the trade. So that word premium can really just kind of screw the whole thing up and make it complicated. But if you instead think about it as credit and debit, those are more common words, and they would perhaps make a little more sense. When it comes to those words, credit and debit is very similar to risk and reward, or profit, loss. They're all three the same, right? We got credit, we got risk, we got profit, we got debit, reward, loss. Of course, I should put them on the right side. Let's swap these around so they're actually on the right side. Credit and reward are the same thing. Debit and risk are the same thing. Profit and credit, profit and reward, reward and profit, those are all the same three words. Debit, risk, and loss are all the same three words. Premium would really depend on who you're talking to and which direction you went, much like margin. Because if you're talking to a margin trader who's trading futures, margin could be what the value of the contract is going to be plus buying power. But if you're talking about, say, a trading account, quote, with margin, then that could be borrowing power. Well, you paid the quote premium to open the trade, right? If you just take that word and get rid of it completely, just totally eliminate it from your vocabulary, or share it with me in the context that you found it, that would help go a long ways, right? But the best thing to do would just be to take that word and throw it in the trash. That way, you never have to worry about which premium you're talking about. Like margin, I hate to even use the word margin in context. I almost always say buying power reduction or borrowing power, or, that way I don't run into 3 different margin people who say, well, margin means this. No, wait, margin means that. No, wait, margin is this. So everything has theta decay. It's not the idea that you can get away with not losing theta decay, but when decay kicks in, it can pay you or it can take money from you. Either way, it's going to be there. So then the idea becomes, which side of the trade are you on? So for an example, we'll just go out here and we'll build a credit spread and we'll build a debit spread. Now remember, a debit is a trade that's affected by theta, because since we're the buyers, we're losing money to theta every day. And if we're the credit seller, then we're making money from theta every day. But let me show you that that's not technically true. So here's the credit spread, and here's the debit spread. We'll turn one of them off, and we'll look at debit first. So in this trade, every single day, it's going to lose theta. That's a given, no matter what. But the loss in theta can help us, or the loss in theta can hurt us. So right now, if I'm on this side, the left side of break even, if I'm on the losing side of this trade, every day theta is going to kick in, and this red line is going to move closer and closer to this black line, to the at expiration line. If price didn't move, and suppose price was just right there at 20, we'll say 27.90. If that's where price got to and it never moved it from there, it just stayed there, every day we would lose more in this trade from theta decay. But if price runs all the way to $29 and doesn't move again, every day we're going to make money from theta decay. Now remember, this is the debit spread. So every day this debit spread is gaining in theta value, and it's paying us. Price doesn't have to do a darn thing. If it stays right at $29, every day this trade would make more money because we would be paid in theta value. So you can't get rid of the theta, but you can work with the theta or you can work against the theta. And depending on whether you're on the winning side or the losing side, that theta is helping you or it's hurting you, but it's still there. You can slow it down. You can decrease how much theta decay kicks in on a day-to-day basis. And that would be coming in and trading a single versus a spread, or where you built the spread. And then that gets a lot more complicated, and that gets us into the Greeks, which we don't want to get into today. Not necessarily. I mean, where you pick a trade, say you want to just trade options, where you choose your options trade on the chain is going to be affected by theta value. And you can see that theta. It's not hidden. So here's your theta values. Notice if I go very far out of the money, the theta impact is almost non-existent, right? There's no impact from theta. But the closer I get to the money, the higher that theta impact will be. So I don't necessarily have to trade a spread to decrease my theta value. I could just go farther out of the money or farther in the money, because you can see it decreases that way too. But who would want to buy that deep in the money, right? Like, who would even want to trade that deep in the money? Now, see, that's where people go wrong. You really don't want to try to go in there and calculate that decay every day. It's just going to hurt your head. And especially if price moves, and then what? You got to start all over again, right? Like, the impact is negligible when you're trying to figure out, well, what will my trade be worth tomorrow? You can look up and down the options trade and see what it will be worth tomorrow, next week, next month, next year. One more thing to keep in mind is that theta is often displayed as some linear line like that. And that's absolutely not how theta goes. Theta is like that. So depending on where price is, and we'll use price along the bottom, depending on where you're getting in, your theta values might be very low or your theta values might be very high. And when price moves along up or down, so does your position on the theta value. And then when you get farther out in time, you can see those theta values are really, really low, and they're really wide per strike range. Right now, I don't have a better way of saying that, but see how the 1 is that wide, and then the 2 is that wide, right? So that's the range that it's, it could go from 34 all the way to 28. You would still have the same theta value. It could go from 34 all the way to 39. You would still have the same, I missed it, 38. You would still have the same $2 theta value. But once you get really, really close, now look at those theta values. And look how narrow the range is in those theta values. 2 strikes and you're out of the 6s. And then, 5 strikes and you're out of the 7s. And then a couple more strikes, you're out of the 6s. So there's not much of a range. And suddenly you went from a 7 value to a 6 value to a 5 value. And because it's that wave that we're talking about. It would be better for you to keep track of which side of the trade am I on a day-to-day basis. Is theta going to help me or is it going to hurt me? And then how can I slow it down or decrease its impact? I often use the phrase shunt. How can I shunt that, like deflection? How can I deflect those theta values? Well, if I just straight up buy a call, I'm going to take all of that theta impact. But if I trade a spread, now I can do something about that theta a little bit, right? And the easiest way to see that would be just to look at a call in the Analyze tab. Notice no matter where we are at here, every day that goes by, if price stops moving, that red line is going to sink lower and lower and lower and lower. So I'm going to get hit with theta no matter what if I buy that call. There's no way around it. As soon as price quits moving, this red line is going to sink on a day-to-day basis closer to that red line, that black line. That's that theta decay. You can't get around it. Not when you buy that call. But if you buy that call spread, now depending on whether we're above or below the break even, that theta decay is going to pay us or it's going to take money out of our pocket. You absolutely can day trade spreads. I do it all the time. In fact, the 0-day spread focuses on the idea, this very simple logic that at expiration, anything out of the money is worthless. It's zero. It's junk. It's trash. It's smoke. It is gone. Which means if we sell it, no matter how much we sell it for, at the end of the day, if it's a 0-day option and it's going to expire today, at the end of the day, if it's out of the money, it's worthless. It's trash. It's gone. I could sell this spread for $5,000. At the end of the day, I will make my $5,000 if it's out of the money. Now you can do the same thing on debit side. You can day trade a debit spread, but then you need price to move, and all the other things being equal, you'll get some theta value, or you'll get that decay at the money, Namita, which I covered in the Greek video in the Next Level Training Library. If you want to take a directional trade and you want to shunt the decay as much as possible, you would trade it at the money. If you want to go even farther and start getting way out there, it's not going to be the theta values that you need to worry about. It's going to be the effects of getting the move in the market high enough to even hit that. There is no how far. At the money or not, that is your way of neutralizing theta as much as possible. Any expiration, whether you're 1 hour from expiration, 1 week, 1 month, 1 year. Your question is basically like, how can I avoid bumps in the road? What's the sweet spot for avoiding a bump in the road? Right? So you can build it at the money anywhere. And that is going to be your greatest way of dodging or shunting the effects of the theta. But you're never going to hide from it 100%. And you're never going to be able to totally protect yourself. All you're doing is slowing it down, decreasing it, deflecting it a little bit, as opposed to just buying the straight out call or the, just buying the put, either one. Remember, you can't game the system. So that's not even a thing that can be done. If there was some magic number that everybody could point to and say, oh, right there, if you just do that right there, then the theta will never hit you and you'll be fine. If such a thing existed, it would be hammered into oblivion. Everybody would do it. There's this crazy idea, and I couldn't figure out why they did it at first when I first heard about it, that the trading firms go to the colleges and try to hire the best mathematicians in the world, math and science, and hire them to work at the trading firms. And I thought, why would you get some noob who has absolutely no idea how to read a chart and pay them hundreds of thousands of dollars a year to work at a trading firm? The guy don't even know how to trade, because it's all in the math. They just want someone to come in there and crunch the numbers and to develop a new way to trade something more safely, to game the system in some way. And I consider myself slightly smart. I mean, I'm not a drooling idiot. So I kind of figure I got a little bit of game against the people that we're trading against, but I'm in no way like some, doctorate in mathematics. And those people are running circles around all of us, right? Like, they built the models that these machines run on. Kind of smart. Way, way over our pay grade. We ain't going to game the system. I am going to kill the recording, though, now. I'm not going anywhere. We can still chit-chat or whatever, but that way the stream doesn't get too long. Unless there's any more questions on what I covered today, then I'll keep the stream on for that, the recording, and we'll just, go from there.